Every time I meet up with friends, the topic of investing eventually comes up. Some of them are new to the game and ask me for ideas or tips. Hi everyone, welcome to Money Savings Canada. Let's talk today how to put savings to work and build your investment portfolio.
Here's what we're covering today. Investing 101. Asset allocation. How to build your portfolio. Portfolio 1. Simple and growth-oriented. Portfolio 2. Focus on income.
I've added time codes below so you can easily navigate through the video.
You might already be investing, or maybe you're just starting out. With thousands of options out there, how do you choose wisely? You don't want your money to sit idle earning almost nothing. But you also don't want to risk losing it all chasing big returns.
My friends already understand the importance of diversification, so one of the most common questions I get is, what's your ideal investment portfolio? Of course, there's no such thing as a one-size-fits-all solution. Before building any portfolio, you need to understand your own risk tolerance and investment horizon. Ask yourself, what matters more, maximum growth or stable income? Before we dive into portfolio options, let's take a moment to revisit the basics, what asset classes are, and why asset allocation matters. Investing 101. Asset allocation. Asset allocation is the secret behind smart, balanced portfolios. I'll cover what it is, why it matters, and how to build one tailored to your goals, risk level, and timeline. Asset allocation simply means how you allocate your money across different asset classes like stocks, bonds, cash, and alternatives like real estate, Bitcoin, and other crypto. Nothing fancy, just smart division to balance risk versus reward based on your situation. Alternatives are a completely different story. Today, I will focus on stocks, bonds, and cash. Stocks, since you are buying a share in a company, you are involving in all risks associated with company's business. Shares price of successful company will rise, and you could sell it for the profit. Also, some profitable companies share his success with shareholders by paying dividends. In contrary, company's business is struggling and their share price will go down up to the floor. Potentially, you could lose all your money. Bonds have fixed income. You are lending money to government or corporations. You receive a regular income as a coupon payment. You can buy and sell bonds on a market like shares. Yes, price of bonds could fluctuate similar to shares. Safety of this type of investments depends on reliability of issuer. Government bonds usually are more secure as corporate bonds. In general, bonds are considered safer than stocks. Cash and cash equivalents. It's money on saving or checking account as well as money invested in GIC. The risk of losses is close to zero, but income is very low as well. I'm not considered cash as investment, but it's a rule of thumb, have a portion of your portfolio in cash for immediate spending or for emergency expenses. Remember about inflation and purchasing power. Keeping money idle can actually lose you money. Each asset behaves differently. Stocks offer high growth, but they're volatile. Bonds are more stable but deliver lower returns. A thoughtfully diversified portfolio can help smooth returns over time, decreased volatility, and give you peace of mind. Strategic asset allocation means set your targets, stick to them, rebalance periodically. This adds discipline to your strategy. How to build your portfolio. Two key personal factors shape your allocation. Risk tolerance. Are you okay with market swings? Time horizon. How long until you need the cash? A retiree nearing 70 needs stability. A 25-year-old has decades ahead, can lean into stocks for growth. Sure, you'll find thousands of tips and model portfolios online. I've summarized the key ideas in one simple table. Let's explore sample allocations. As you can see in this table, these sample portfolios follow a common investing principle, gradually reducing risk over time. That's why investors typically rebalance their portfolios, shifting from higher-risk stocks to safer assets like bonds and cash. Nothing is set in stone. Every portfolio should be tailored to your lifestyle, savings, side income, and emotional comfort. Let me share two of my own portfolio ideas with you. But before we dive into my sample portfolios, let me first explain why my personal portfolio includes ETFs only. First, you don't need hundreds of thousands of dollars to build a well-diversified investment portfolio. This is especially true when it comes to bonds. While you can buy individual bonds through platforms like Questrade, the order minimum for bonds at Questrade is $5,000. In contrast, bond ETFs can be purchased in any amount, making them far more accessible. Second, most ETFs are already well diversified. You don't need to spend countless hours researching individual companies or bond issuers. ETFs do that work for you by pooling a wide range of assets into one simple product. Let's take a look on two different portfolios. They are not tailored for different ages or investors' risk tolerance in mind. Feel free to adjust these portfolios to fit your investment strategy and investment goals. Portfolio 1. Simple and growth-oriented. Warren Buffett said,
By periodically investing in an index fund, for example, The know-nothing investor can outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb.
In one quote, he will mention two important concepts, first known as dollar cost averaging or DCA. Instead of investing a huge lump sum, you invest a fixed amount regularly, say monthly. This automatically smooths out cost, buys more when prices drop, less when high. It takes emotion and market timing out of the equation. Second idea, invest in low-cost index funds. Here are the few well-known Canadian index funds. First Group Funds holds Canadian companies only. XIC from iShares' well-known name in Canada. The ETF has a long performance track record and ranks among the largest ETFs in Canada by assets. MER, 0.06%. It offers a great yield, with distributions being paid to investors on a quarterly basis. Yield 2.51%. ZCN from BMO Global Asset Management. ZCN offers a good yield, with distributions also being paid to investors on a quarterly basis. MER, 0.06%. Yield 2.54%. VCE from Vanguard, another well-known global asset manager. In Canada, Vanguard's VCE ETF tracks a similar group of stocks as those contained within the S&P/TSX 60 index, investing in roughly 50 of the largest Canadian stocks by market capitalization. MER, 0.06%. Yield, 2.75%. Worst to mention, all these funds hold over 50% of its assets in the financials, energy, and industrial sectors, because it's a nature of Canadian market, over-concentration in these sectors. VCN from Vanguard follows the FTSE Canadian All-Cap Index, market index comprised of large, mid, and small-cap Canadian stocks. It gives you broad exposure to different kinds of stocks in the Canadian market and has a low MER, 0.05%. Yield, 2.55%. For most Canadians, Canadian stocks are an important part of an investment portfolio, and the above ETFs are good options. But for real diversification, you have to add in your portfolio ETFs focused on US and global markets. VFV from Vanguard seeks to track the S&P 500 index. It invests directly or indirectly primarily in stocks of US companies. Sure, you will not be surprised to know, top 10 holdings are including Magnificent 7 stocks in Berkshire Hathaway Inc. MER, 0.09%. Yield, 1.02%. Next is XQQ, iShares NASDAQ 100 Index ETF. This fund seeks to provide long-term capital growth by replicating the performance of the NASDAQ 100 Canadian Dollar Hedged Index. MER, 0.39%. Yield, 0.26%. Some advisors recommend investing directly in U.S. markets by purchasing U.S.-listed ETFs in U.S. dollars to avoid the withholding tax on dividends. Is this good advice? It depends. This strategy can make sense if you're investing through an RRSP, as the 15% U.S. withholding tax on dividends does not apply. Unfortunately, this tax exemption does not extend to TFSA. If you're using a TFSA, it's generally better to stick with ETFs listed on Canadian stock exchanges. XEQT, iShares Core Equity ETF Portfolio. This is fund of funds represents a simple and efficient way to gain exposure to a portfolio of ETFs that is broadly diversified across regions. MER 0.20%. Yield 2.99%. You have to decide by yourself about percentage of each ETF in your portfolio. I would invest first 40% equally in XIC, ZCN, VCE, and VCN, then VFV and XQQ, 15% each. XEQT, 30% of my equities portfolio. If you decide to add bond ETFs to your portfolio, you might consider the following two funds. Split 50/50 within the bond portion of your allocation. ZAG is BMO Aggregate Bond Index ETF. This ETF has been designed to replicate, to the extent possible, the performance of the FTSE Canada Universe Bond Index MER, 0.09%. Current yield, 3.49%. XSBI Shares Core Canadian Short-Term Bond Index ETF. This fund seeks to provide income by replicating the performance of the FTSE Canada Short-Term Overall Bond Index. MER 0.10%. Current yield, 3.17%. This sample portfolio is designed with long-term growth in mind. The dividend income from these ETFs is modest, but should be seen as a bonus, not the main goal. Diversification across sectors, regions, and asset classes helps manage risk and improve overall performance over time.
Just a quick reminder, folks, I'm not a financial advisor. I see my audience as smart, capable individuals who take responsibility for their own decisions. My job isn't to tell you what to buy, but to offer ideas and practical information that can help you make informed choices. And remember, always do your own research.
Portfolio 2. Focus on income. There are several approaches to building an income-generating portfolio. One popular method is the Dividend Growth Investing Strategy, or DGI for short. The core idea is to create a portfolio of dividend-paying companies, carefully selected based on specific criteria. You've probably heard the term dividend aristocrats. These are well-established companies with a long track record of not only paying dividends, but consistently increasing them year after year. In recent years, the market has also seen a surge in the popularity of covered call ETFs. These funds offer relatively high yields and have become especially attractive to income-focused investors. Essentially, covered call ETFs trade the potential for long-term capital appreciation for higher income today, often offering double-digit yields. Sounds too good to be true. Well, it's important to understand how these funds generate that income and the additional risks involved, especially if leverage is used. Covered call ETFs are a topic that deserves a dedicated video, so stay tuned and subscribe to my channel. That video is coming soon. What I would add to my income portfolio? XEI is iShares S&P TSX Composite High Dividend Index ETF. This ETF seeks long-term capital growth by replicating the performance of the S&P TSX Composite High Dividend Index. It offers performance similar to other index ETFs, but also pays decent dividends. MER, 0.22%. Yield, 5.38%. EITUN, Canoeite Income Fund, one of Canada's largest closed-end funds. It's income-oriented, actively managed portfolio, focused on quality franchises, stable businesses, and long-term sustainable growth. Well-diversified across sector and market capitalization. Yield 7.70%. HDIV is Hamilton Enhanced, Multi-Sector Covered Call, ETF. The fund of funds seeks to provide attractive monthly income and long-term capital appreciation from a diversified multi-sector portfolio of primarily covered call ETFs, focused on Canada. It uses modest cash leverage of 25% to enhance yield and growth potential. Yield 11.51%. HYLD is Hamilton Enhanced U.S. Covered Call ETF Fund, offers a higher yielding alternative to the S&P 500 with similar volatility, because it holds a portfolio of U.S. equity covered call ETFs, with overall sector mix broadly similar to the S&P 500. It uses modest 25% cash leverage to enhance yield and growth potential. Yield 12.83%. While these ETFs deliver high yields, they're still equity-based, and that comes with risk. To help reduce downside risk, it's wise to add a bond ETF to the mix. For example, ZAG, the BMO Aggregate Bond Index ETF I mentioned earlier. It offers a modest yield of 3.49%, but it can bring added stability and peace of mind to your income portfolio. If you split your investment equally among these 5 funds, you'd end up with a portfolio yielding around 8.18% on average.
What do you think of these sample portfolios? Share your thoughts and your own asset allocation approach in the comments.
Tax efficiency is not discussed in the video, because if you're investing through registered accounts like a TFSA or RRSP, you can focus on performance and income without worrying much about tax optimization. Once you've maxed out your TFSA and RRSP, taxes do become more relevant, but that's a different topic entirely and goes beyond the scope of this video. The idea of asset allocation in your portfolio isn't some magic formula. It's simply smart, well-structured planning. Set your goals, know your risk, build your mix, automate it, tweak it, and keep going.
Thank you for joining us today. Want more real talk about investing, money, tips, and tools that actually work? Subscribe and stay tuned.